I'm Catherine Ross, and I'm here live from the NYC with Jim Cramer. Jim, the market was stuck in the red earlier this week.
Right.
Now it's rebounding. We got the S&P hitting 3,000.
J-Pal gave us something. He gave us a real Christmas in July. What he basically said was, all right, look, I probably have to cut because of trade turmoil. Productivity, good. A lot of people still being laid off, minorities not being hired enough. And what he basically said was, because of policies by the government, he may have to cut. Now, I think may have means he will. And therefore, we may lose the inverted yield curve. So that's going to bring buyers back. He also, whenever you ease monetarily, you're going to get people buy technology stocks, get people buy commerce, you're going to get people who buy fintech, and you see, but you're also going to get people who buy healthcare because they say, wait a second, the Fed thinks that things are slowing. They'll buy remarkable renaissance in everything that involves a slowdown. Procter & Gamble and PepsiCo. Yesterday we hated, now we like. It's why I always say, please, do your own work. If you're buying things because the futures are up, you're going to get whacked, and I don't mean Walmart, Amazon, Costco, Target, or Watch at a Home Depot. You have to look at how companies are doing, because if you just follow the S&P and you go by, say, everything that's fintech, like American Express, Visa, MasterCard, that's great. Okay, that's great until they report. Now, I think that American Express may not be that great. Visa should be good. MasterCard, which we own for Action Alerts, is fantastic. But I'm still urging people to look at individual stocks, because when you get sucked into buying things because of the futures during earnings season, you get hurt. Look, there are 12 weeks a year where I will say that. If you get sucked into buying because of futures, you could get hurt by earnings. I'm giving you 40 other weeks that you can play this game.
Last night we got earnings from Levi's, which is a real money stock of the day.
Disappointing, and I'm working on a piece about it, taking a little time, because I am more critical about it than other people are. I know people thought it was better than expected. I didn't. Better than expected would have been that U.S. would have been strong. There was a deceleration. I don't know how much is Levi Strauss. Why? Because their end markets are hurting. Is that their fault? No. But what does it say about JCPenney? Not great, right? What does it say about, I'm worried about Kohl's. Now, we own Kohl's, and it's going to get boosted by its Amazon return policy, and it fully reflects how badly Levi's has done. It doesn't reflect anything positive, but the outlook for on the Levi's call was really suboptimal, and the worst line on it was, we do have a strategy. I mean, wow, okay, thank you. So it was just, you can't pay 22 times earnings for a company that disappoints like that. Remember, forecast's more important than numbers.
I'm glad that you bring up the outlook, because they said, if you guys missed it, they said that going into the second half of the year, they expect sales to slump a little. Well, now, based off of that...
They said there's not going to be a good Black Friday, basically, Christmas, Black Friday. One of the things, they didn't even talk about back to school. I was at a Target yesterday. Back to school's killing it. They're killing it. So this is much more to do, I think, with the mall, with end markets, but it was not a good quarter. And what I urge people to do, listen to the call. I mean, let's say PepsiCo yesterday, it was up $1.50. If you listen to the call, you would hear that the analysts didn't like it. No, I thought that was an opportunity, but you would hear that. Levi's, better than expected. That may be a headline, but it was worse than expected. And don't kid yourself. It is not what we're looking for, okay? I find this to be the case. Many companies, they say, people grab a headline, say better than expected, and then won't listen to the call. And they had a bad quarter, and they said the next quarter is going to be worse. And this stock came, the deal was at 17. I think it could be, I was talking with Ben Stoto about this, I think you go back there.
Do you think that Levi's earnings will reflect poorly onto their brick and mortar business?
Not necessarily their brick and mortar, because they say that theirs are good, but look, I think that JCPenney still has $12 billion in sales. Let's just use that as an example. I think that these are going away. Macy's sales need to pick up. Kohl's sales need to pick up. But the winners, look, TJX could be a winner for this. Of course, Levi's did say that the inventories are lean. I have no idea what would happen if the inventories weren't lean. But I do point out that, in general, this was a quarter which says that if you buy a mall stock, you'll get hurt.
All right, Jim, now before we go, you've got some exciting news. You've got a call coming up next week. Do you want to tell everyone who's viewing what that's about?
Sure. We own some expensive stocks. We own Shopify, okay? We own Twilio. And we're going to talk about how to own an expensive stock, which is certainly very, very difficult. I'll give you some personal remembrances of when I've done that. It's funny because when my daughter and I were walking through San Francisco, I mentioned this the other day, she was pointing to buildings and she said, how about this one? And she pointed to Okta. And ever since then, it's been stuck in my head as the best performer of this group. By the way, Symantec is a competitor to Zscaler. I still think they can get $28 bit from Broadcom, but it's cybersecurity. And I just think that to own an expensive stock requires a different skill from owning a value stock and different skill sets, and I'm going to explain that. I also probably will throw in again, if you buy stocks because of the futures during earnings season, you're really a sucker. And I don't like suckers. I don't want you to be a sucker. I know, Catherine, that there are a lot of people who say, look, this is a Fed-induced bubble. On a day like today, it's a Fed-induced rally, and I don't like that kind of rally. I'm one of the, Carl was going over the best performers during this last go-around, and he talks about AMD and NVIDIA. Why? Well, they're innovative. AMD overtook Intel. NVIDIA became the ultimate artificial intelligence machine learning chip. Those were not Fed. Now, you may say you're paying more because of the Fed. I would say that's ridiculous. You're paying not a big price to have those. Facebook, good piece yesterday out about how Facebook's not expensive. Alphabet's not expensive. Of course, Amazon is expensive. Apple's not expensive. So, you may think that you're paying up because of the Fed, but the multiples for some of these incredibly high growth stocks are not that bad. This is not, I guess what I'm leading up to is this is not 1999. It's just not. When Cisco sold at 80 times earnings. It's just not. Cisco sells it, well, I don't know, 15 times earnings with a very good acquisition yesterday. There's just a lot of stocks that are not outrageous, but the main thing I'm going to talk about on that call is how to own something that looks outrageous and how to value something on the out years.
Now that call will be broadcasted live next Wednesday over on ActionAlertsPlus.com, where you can go and sign up for a trial. All right, Jim, that's all the time that we have for today. Thank you for joining us. For all of you watching on TheStreet.com or on Facebook, we are now jumping over to our Action Alerts Plus members-only club video on ActionAlertsPlus.com. I'm Catherine Ross, and we'll see you tomorrow.